Welcome to the ArcFluence Podcast, where we talk about how design impacts the way we live, work, and invest. I'm Nick Caracan, your host, and today with me, as always, is my business partner and co-host, Paul Fack. How's it going, Paul?
Good. We get to talk about the last thing in our catchphrase, investing. It's going to be fun.
My favorite. So this is episode 24. Our guest is Liz Lawrence from LFG Lending, and she's an investor herself, has a lot of information to throw at you about lending if you're coming from the investor standpoint piece. Great episode. Really excited to dive into this, and here we go. Liz, welcome to the show.
Thanks for having me.
I'd love for you to just tell a little bit about your company, LFG. I know we've worked together in the past, and you've grown quite the business over the last several years.
Yes.
So tell us about your journey, if you don't mind.
Yeah, so I have been in mortgage for, I think, a little over 10 years now. I was in retail lending. The crazy thing is I started as an admin. And I think that story is not traditional. A lot of people that work in the mortgage space got right into more of a sales role, went straight to sales, made it or didn't, and then continued their journey. But I have a little bit of a different story in the sense of I only worked on high producing teams. So I really only know this like fast pace, high volume concept. And so after going on and becoming a loan officer myself, they were like, holy crap, I don't know that anyone has produced as much in their first year of originating than you have. And then it was quickly, I laugh sometimes because if someone looked at my resume, they'd probably be like, you're not qualified to be doing what you're doing. And it's just because I've grown so quickly, so fast with the type of mentors that I've had taught me 100%. So much so quickly that honestly in a similar trajectory, someone would have to be in mortgage for 15 plus years to really get the experience.
You see that in real estate for real estate agents where I was in New York City when I was on the Keller Williams team for the agents that got with the teams that were producing and took the punch and the gut and, for the commission and just soaked up that knowledge and learned everything. They went on to have incredible careers.
Yes.
It's funny. You said the one thing where you're like, oh, if you looked at the resume, you'd be like, oh, this person's not qualified to be doing this.
Yeah.
It just, that triggered something in me. It's like in architecture school, they train you a certain way in school.
Yeah.
Right. And you get out into the industry and, construction and design and all of a sudden it's like everything you learned in school is almost meaningless.
Yeah. Throw it out the window.
Yeah. Because like in school, they would put some freaking cloud, floating above everything and be like, oh, this is your building. And how's it going to stand up? Oh, there'll be one column there. The engineer will figure it out. Like that's not what we're worried about. We're focused on design here or whatever. And you're just like, okay. And then you get out into the real world and it's like, none of that applies.
Yeah. I wish my job was that simple.
Yeah. So, but I mean, like to that point, like you really are learning on the job once you get out of school.
Yeah.
So similar thing, like you feel like you're not qualified to be doing certain things. Like once you get into the actual real world, but
and realistically, you had more experience than a lot of your predecessors.
So it's almost the same. It's like you learn on the job, to a certain extent, like even on the architecture side. So
because a normal loan officer typically originates maybe 5 to 10 loans a month as like a normal good average originator. And some of the loan officers that we were covering, we were closing, 30, 40, 50 loans a month. And so you just got to see more deals. You're
putting in the reps.
Exactly. And so you were understanding the problems that could come up that other loan officers may not see for 5-10 years because they just haven't had the experience. And so at LFG Lending, we're a mortgage brokerage that focuses solely on investment real estate lending. So it's the only thing we do. I did do retail lending, so I can definitely speak on like the first time home buyer experience and how that looks, feels, and functions. But everything we do is very investor friendly. And we lend nationally. We work in short-term and long-term financing. So we're really your kind of like one-stop shop in regards to lending if you're trying to be an investor.
So fun. I love it.
Yeah. The phrase that sometimes comes out is we're the wild, wild west of lending. It's not the thing that people traditionally use. And so I tell people often that, you're not expected to know the moving parts of these transactions. You're not supposed to know how they work, feel, and function. That's what they pay me for.
Yeah.
So ask the questions because honestly, we don't know what you don't know. And you're not expected to know it either. So it's just a lot of moving parts to be educated in this space, which I think is essential.
Yeah.
I wanted to kind of get into how your role interacts with our industry as designers and just kind of if you could paint us a picture, like what does that relationship look like? If I were interested in as an investor or as a first time investor in getting funding, that's going to be a little different than what would have been if I was buying my first home.
Yeah.
What does that look like? Things like that.
Yeah, I would say, hard money financing is probably going to be the product that you use. And the reason that that's going to be applicable is you're likely going to be buying a property that needs some TLC. And a hard money loan or a fix and flip loan, same loan, different terminology. I don't know why we all call it something different because it makes it confusing for people. But
so just to my mindset as well, this is something where you don't have a property yet, or you already have a property, and then we're approaching to say, hey, we either have a property or we're interested, or is it either case applies?
So the cool thing about our lending space is there's no income validation. So it's not like I'm pulling your tax returns and your pay stubs and we're trying to see if you debt to income qualify like a conventional loan does.
Does the deal work?
Yes, the deal works or it doesn't. And my lending is approved as long as the deal works.
Yeah. So you could have a potential deal, or you could already have the property and you just need the funds to renovate.
So
and then it all comes down to, does it work or does it not work?
Exactly. So we can kind of give you the structure of like what a good deal looks like in our eyes, what the lender's going to like, and then you're going to try to find a deal that fits in that box.
Yeah. Okay.
And just to let everybody know, you're an investor yourself.
Correct.
As am I. So it's when you are working and building your team, it's really important that those team members, whether they're directly related to investing or not, have experience in that industry, right?
Well, 100%. We talk about setting up your team before you even potentially start looking at transactions, because honestly, if you don't have your realtor, your property manager, your architect, your designer, your stager, your lender, your title rep, I'm still going, and I still have plenty of other vendors that you need on your team. But if you don't have these people, you're going to get into that first deal and you're going to stutter step all over the place trying to figure out who are those people that you need to make a successful transaction. And I think too often people get excited, and I get excited. I mean, all of us, I think when you get a new deal, you're like, okay, I got a new deal. Here we go.
Yeah.
And I don't want to lose that excitement, but I also am like, are you ready for the deal?
And we need to understand the timelines for all those different people. How long does it take to close a deal?
Yeah.
I mean, I've closed deals in a week before. Sometimes it takes 2 months.
Mm-hmm.
So, and contractors, how far out are they? Your architects, how far out are they?
Yeah.
What's that timeline look like?
Yeah, I feel like on the design side, the architecture side, we can usually hit timelines pretty well. But I feel like when you get into construction, it always gets extended. Is it something similar in financing where you're pretty good at hitting deadlines? You're not necessarily like, oh, we need another couple of weeks to close it.
Oh gosh. No, I wouldn't have a job if that was the case. I would say, short-term financing. So again, back to that fix and flip or hard money loan. Those close in 2 weeks or less. If you're going new construction, I would say probably 30 days just to be safe. I would say delays happen back to the team aspect. If you don't have all your stuff in line as to what I need to do my deal doesn't really start until I have plans and specs. I have a cost breakdown. If I don't have those things, then as far as I'm concerned, my timeline hasn't even started yet.
Right.
You need to go finish those things up, get me a full package, and then I can work my magic.
Well, the financing side of it too, is somewhat time sensitive. It's not like you can go out 3-4 months later because the market could change dramatically, and then all of a sudden the deal might not make sense anymore.
That has happened numerous times just in the last couple of years, where a couple comps come through the neighborhood that ruined the after repair value, or ARV. I'll probably say ARV at some point throughout this. So you have to be mindful of time. Time's going to affect this transaction considerably.
Now, are you directly involved with the designers, the contractors, or do you leave that up to your client?
I would say involved is probably a vague term. I have communication, but I don't know that I'm involved in making decisions. And more so because I want to make sure that that's left to the investor and that it correlates to the numbers. So to kind of go back to a fix and flip loan, I think that's probably the loan product that an investor that's listening to this is probably going to use. So a property that needs some TLC, that is potentially going to the studs and back and has a lot of, opportunity to kind of put their little quirks and design aspects into it. From there, you have to have a conversation with your contractor first to really figure out, because I'm going to look at purchase price rehab, and after repaired value. And that's how I'm going to say, yes, this is a good deal. No, this is a bad deal.
And what does the ARV typically need to be like? What's those percentages for you typically?
So
I want to jump into, I think, so I worked for a development company back in the day. It was like construction, developing, architecture. So it was like all under one umbrella. I think they were shooting for like a 15 to 18% like return on whatever they were doing. So if they were going to say, hey, we're going to invest a couple $1 million in an apartment complex, we want to see this percentage back on. So like if the deal was at like 13%, they'd be like, no, we're not doing it.
Yeah. And honestly, for me, at least, it depends on the market, like where you're at, like what area, because
it was a little bit of a corporate structure, but they were very rigid and they're like, if it's not at least 15, we're not doing it.
Yeah. I've noticed that my return on investment has been going down in Columbus because values have been going up.
Yeah.
So it can change with a lot of different factors.
All right.
Yeah.
So what number for you? What's the magic
So
number?
I always like to make math simple because some people are like, math, that's not my wheelhouse. And so let's make it super, super simple. If you are looking at an after repaired value of $100,000 in Columbus, are you going to find that? Probably
No.
not. But makes math easy. Makes math easy. You're going to want to find a deal that hits at 75 to 80% of the after repaired value, max. Anything less than that is gravy, but max is where you're going to want to be. So that means your purchase price and your rehab, you want it to not exceed $75,000 to $80,000.
Got it.
Both of those things. And in that scenario, you'll probably bring 10% down of purchase price, 10% down of cost. Yes, we have 100% financing lenders, but like it's going to be so particular if you qualify for that I tend to not like scream that from the rooftops. And then from there, we're actually, and again, that gets into this whole design aspect. Okay, if what we, Brooke and my wife Brooke and I do is we buy rentals, we buy something that needs some TLC, we make it rental quality, which is
not as fancy as I like.
Not as design focused.
It's okay.
And then we refinance and keep them as rentals. So we're using the BRRRR method.
I mean, you can't take every project and dump in money like it's no object, So like we get it. Like sometimes you fix it up to where it's functioning, it's livable, there's no issues.
Yeah.
And someone can go there. I mean, like again, like there's people that do that all the time. So
I love the BRRRR method. Sarah and I do that as well. And we're not talking about it being cold outside. Do you want to tell us what the BRRRR method stands for?
So you are buying, rehabbing, renting, refinancing, and repeating. And the goal of that method, and honestly, if you're a brand new investor, like that's where you probably need to sit. That is the best way to strategically use a lump sum of money to scale it into as many doors as possible. The hope is that you take, let's just say it's $50,000 or $100,000 and you buy as many houses as possible with that transaction. So we could go into the weeds.
Gosh, I really want to talk more about this, but it might be too nerdy for
I would say, again, if we're focusing on design, I would say,
I mean, like invest is in our catchphrase,
Sure.
right? So I mean, like we can lean more towards the investment side, but I mean, like there's design, like you said, when you're thinking about what to do with the project. Especially if you're renting it, you're not going to be doing high end this, high end that. It's going to be bare bones. Yeah. So I mean, like again, like that's design consideration right there that we're talking about. So yeah, if we lean more towards investment, we're fine. Get into it, Nick.
I would say in that aspect for a BRRRR, so I think I could take this a direction. I think you need to mimic your neighborhood, which could just change the design. Yeah. So like we always joke that the neighborhood that we own rentals in is like Schitt's Creek, if you've seen it on Netflix. Like, it's just
love Schitt's Creek.
A C-class neighborhood, B-class neighborhood, just like simple folk. There's nothing wrong with it. But do I need to change my finishes to a certain extent to satisfy the tenant? No. They just want a nice house, and I want to not be a slumlord, and so we put good finishes in it. We have granite countertops in these properties,
sure.
More so for longevity than anything.
Yeah.
And so we're mindful of those kind of things. But if I change to a higher end neighborhood, I definitely need to start thinking more design oriented and making sure that I'm attracting the right tenant to come into this property, especially if you're expecting, high rents.
Sure. We're mostly.
That's kind of the point I was making the other day on the call where I was like, if this is just like a rehash of what's there, and directly what's there and what's there is not very good in terms of like trying to attract a new tenant. I mean, like it's going to be hard to attract somebody.
And you heard what I said. I said, look at the neighbors.
Yeah. The neighbors are actually pretty nice.
I didn't say to do cookie cutter, but
we didn't get into it on the call, but it was a similar type of conversation where it's like, I was a little bit worried that it's not going to be a good enough design to attract somebody, right? Like what they want to do to it is just not to the level that's going to make it attractive.
So I typically invest in, B plus, A minus, A class neighborhoods. And that's because we do short-term rentals, and we usually need, for us, it's so much easier to run a successful short-term rental and have the budget to do some really nice finishes to create that experience for our guests. Obviously there's some challenges with that because your profit margins are a lot smaller, and
then it makes lending more difficult.
Lending is a little bit hard sometimes, even after years of success. So what's your typical client? Is it typically the C-class rental type person?
I would say that is what I go after personally as an investor. Like a B-class rental for me is perfect in a BRRRR transaction. So buying it with a hard money loan, I guess I'll get into a little bit of the weeds. Buying it with a hard money loan, let's just say putting 10% down of the purchase price, rehabbing it, taking a month, 2 months, depending on how fast your contractor works, and then refinancing this into a DSCR loan, which is a debt service coverage ratio loan. Also a no income validating loan product.
Very similar to most long-term
30-year fixed mortgage, cookie cutter, super simple.
Yeah.
And the goal, I would say, so a perfect BRRRR is every dime that I put into the hard money loan, I get back in the refinance. Now, do I think perfect BRRRRs are out there? Yeah, I think they're out there. Are they easy to obtain? No. And I think there's a false expectation. I think a lot of the social media gurus are like, you can get into everything and put no money and you can scale your $100,000 and still.
It's like the HGTV approach. Just, get in there and do it. Flip it. Yeah, everyone's making money.
I would imagine that's why you have a lot of properties in Dayton. The BRRRR works out a little bit better.
Works out freaking perfectly.
Yeah.
Or I think it's changing your mindset of what a good BRRRR is. Yeah. So we tell our clients that a good BRRRR is still something that you're leaving 5 to 10% of that after repaired value in the transaction. So back to my $100,000 analogy, if you're leaving 5 to 10% of that in, 5 to 10 grand in the transaction, that's still a good transaction because alternatively, if you were to just buy it turnkey, you'd be putting 20% down, $20,000. Now you're buying 4 houses for the price of 1, 2 houses for the price of 1.
Yep.
That dog still hunts.
Yeah, we're in a B plus, A minus neighborhood for our last duplex we did, and we left probably 15% in it.
Which that's okay if there's a reason for it. And so I always say, okay, if we're at 15%, why are we at 15%? Tell me, are we in a neighborhood that's going to appreciate considerably? And that's why, and we're going to see that return somewhere else. Are we getting so much cash flow in the back end that I have 15% into it? That makes sense. And I had an investor recently where it was a 4-plex, and I was like, is this where you want your money to live?
Yeah.
That's a whole nother aspect of this. This could go into, tax questions of do you need to acquire something so your tax burden's less? And is this okay where, is this cash being in this deal fine for you? When it gets down to it, it's up for the investor to make. We're just here to give the numbers. I'm a numbers girl. So I look at the numbers and I say yes or no. It's for them to make a decision after that.
But the mindset is to not have it sit there tied up, right? So if you can pull it out and use it for something else, then you use it for the next project.
And what we do is if the situation, sometimes it is what it is. We like to, I want a composite deck. I didn't want to do, we wanted a nice composite deck. So we spent the money. Obviously, that changes our numbers a little bit. But we also, I think we're going to, with the neighborhood we're in, the increase in value, in a year or two, we're going to be able to pull out a HELOC and have a very healthy, line of credit to invest in other things should we need to.
Yeah.
Yeah. I think, like you said, too, mindset of just maintenance and repair, right? You don't want something that's 5 years later, you're going to have to go in there and do stuff, too.
No.
Yeah.
No. And also, hey, if the rates go back down, which they're kind of creeping down in that direction, you refinance.
Don't tell people that. No, I'm kidding. Honestly, they're kind of fluctuating all over the place, and so they went down about 0.5%. They've kind of bounced up a little bit.
Right.
I think
that's
after
why you just
January
keep moving.
we'll know a lot more. I think 2025 is a lot of unknowns in regards to interest rates, and so what we focus on is does the deal work or not? So we're back to does the deal make sense? And if it does for you, pull the trigger. Don't worry about the interest rate. Don't get into the weeds of that. I had a guy last night who was trying to consider a transaction where potentially, because his credit was not favorable, which we can do non-favorable credit, but the rate was going to be high 9s, low 10s.
Oof.
And he was like, oh, and I was like, but does it cash flow? And he's like, yeah. And I was like, then does it matter? And he's like, no. I'm like, Okay,
Yeah.
so we're good. We're gonna keep moving. Like this isn't my fault. Like I didn't do this. Like
When the situation is more favorable, refi.
Exactly. And
Yeah,
that's what I
get
told
that
him.
deal.
Exactly.
Don't let that
lose
stop
the
you.
deal.
Yeah.
Like don't lose your progression.
Yeah. I think that happens a lot. People get analysis paralysis, or they don't pull the trigger because they're because of the unknowns, right? Sometimes you just need to take a little leap of faith.
Well, and I think it's funny the things that people are willing to take the leap of faith on. So like to kind of go back to the fix and flip product, like I think that's where design really comes into play. Like, okay, you have this shell of a house. What are you going to do with it? I have investors that, again, are like me, that BRRRR properties that don't really get into the weeds of it. We've had Airbnbs in the past, and so my wife had a field day with those as she's a home stager. But I would say those are opportunities where people can really take that creative aspect and hire people like yourselves and really have fun with this. And I don't want people to lose the fun of investing.
Right,
It can start to feel like Monopoly, and I don't want us to take it as a game, but at the same time, like this is supposed to be fun and like make those creative outlets happen. The things to be mindful of is like, okay, where is that rehab budget going? One, is it realistic?
Yeah.
Are we staying within that 75 to 80% of that after repaired value, or are we starting to exceed that number? And has a contractor looked at this? Is the contractor willing to do this work that you're wanting?
Right.
Are they qualified to do the work that you're even asking? Like just making sure that you really cross your T's and dot your I's, because in the hard money space, there's holding costs.
Sure.
Yeah. I think that was the second reality when you came out of school. One was that you don't really know that much. And then the second thing was that money really matters when it comes to design, because you're always trying to design to the highest level possible. I feel like that's like, as an architect and as a designer, that's always like your mindset. You want the best product out there. You want your best foot forward.
Yeah.
Right. But then you realize very quickly that, value engineering is a term. And all of a sudden, everything is getting rolled back to, less, like you said, if it's the workmanship or if it's the material or whatever it is, you're taking steps back to basically bring the budget in. Yeah.
Yep.
It's interesting, though, because we'll have clients who have been in the business for years. They've been flipping houses, but the market has changed. Like Columbus has changed, right? So your mind has to change with that. You can't just like, we'll have someone where we're like, hey, we're not going to put a half bathroom in the lower level on a downtown house. I'm like, hey, look, I mean, maybe you can't just turn around and sell this because the ARV isn't there. But like, I think if you and it's always not my advice on strategy for investment, but I love it so much I can't help myself. And I'm just like, have you thought about holding this house for a couple of years as a rental, doing the proper renovation that's going to bring the most value, and then when the market catches up with what's happening right now in that neighborhood, sell it then and make your money. Like, because not putting a bathroom in the downstairs, if he goes and tries to sell it, he just might get into a situation where he can't, and he'll get himself in trouble or herself in trouble.
I think whenever we're talking about like fixing, flipping, and selling, from the design side, you always want to make it as attractive as possible to as many people as possible. So like to Nick's point, if something doesn't quite make sense, all of a sudden you might get into a situation where you have however many people through the house and nobody bites, because again, it's missing one or two things that are just critical to them.
I think that happens religiously.
Yeah.
That they just don't think about the design aspect, and they haircut that budget because they want to stay within this margin. And then all of a sudden, they're sitting on something, and then they call me and want to keep it as a rental. And we're also not getting the rental numbers that we really need because they didn't do the design aspect, because downtown Columbus is known for those like 3-1s, bathroom upstairs. You're having literally people up in your upstairs area, your one place, instead of having something downstairs where
they're parking in the back in the alley, and they're walking into a living room, and there's no mudroom, there's no half bath, there's no laundry. They're not bringing the house to what it should be functionally.
Yeah. You can't just put lipstick on it and be like, it's good.
Right? I think there was a lot of flippers that did it and then learned very quickly that it can work in certain times in certain markets, but not as a
let's talk about.
But also, I mean, like, sure, there's always like a case here or a case there, but I think we're talking like overall, it's probably not a good idea.
So let's talk about the other extreme.
Yeah.
I have been known, and I'm guilty of this. I'll be like, oh, we're going to do this moving island with this hidden entry and this secret pantry entrance.
Because he did it.
And
we're gonna carve out a little section here and make it into like a wine cave. No, literally, you go down into like it's gonna be awesome.
What?
And my colleagues and friends are like, hey, this is really cool, and let's put it on Instagram, but you're not really adding any value in terms of selling this product,
It's true.
But if you want to do an Airbnb, great.
Well, and so in that regard, if it's not growing in value, it's going to be tough for me to allocate a line item in my budget for that and it to help with the after repair value.
Yeah.
And every lender is going to take a look at your budget. But the lenders are not experts either. Some of them do like formal feasibility reports that say, hey, to do what you're saying you're going to do, it should cost XYZ. Does this correlate? Do these match?
Yeah.
Not everyone. And I definitely want to say that like hard money's almost, in my opinion, sometimes too loosey-goosey. It makes me nervous. I get that like budget and I'm like, what are you trying to do? What's all this? Please lender, say something. Because I just don't, and especially for the newbies, I would say that is what makes me the nervousness is like, do you have someone validating that this is going to be enough to cover?
Yeah, I mean, if you're
a
a licensed contractor, you're doing the work yourself. I have a lot more faith in that because you're going to get it done, right? But there's some unknowns that can really bite you in the.
You know what?
Yeah.
Yeah. Well, and especially because material costs obviously were extremely high in the last 18 months. I think they've started to come down.
Yeah, they've adjusted a little bit down. Yeah, downward trend. I mean, lumber at one point was just absurd.
So if someone's giving you a budget, how do you check that? Is that not?
That's the thing, though. Like, keep that in mind. I'm literally going to send a document called a scope of work. It itemizes the categories of work that you potentially are going to do: roof, exterior siding, interior paint, doors, windows, kitchen, bathroom, basements, all the things. So it's a list.
Yeah.
And you write a number in it. And that's what I go off of. Like when I say my lending is loosey-goosey, it is that loosey-goosey. Now, if that number is egregiously off, more than likely the lender's going to catch it.
Flag it, yeah.
But $5,000, they may not catch $5,000.
Right.
Yeah.
But do you have the extra $5,000 to fund?
Yeah.
If you are over budget $5,000? That's a question you have to ask yourself as an investor. I think you always should have extra cash ready for those whoopsie-daisies. Your numbers should be, worked in to,
and again, the team that you're building, if they have the reps that you have, we're doing 100 plus projects a year, if you're doing 40 a month, like obviously you're going to see a pattern. You're going to see what's happening in the market at that moment. You'll have a good pulse on it.
Yeah.
Well, good. I'm glad you brought the team back up because again, like you said, like did a contractor look at this? Like Nick and I, we do quite a number of designs, throughout the year, but still we rely on a contractor who's buying things on a daily basis, who's connected to the labor market on a daily basis in terms of like what things cost to get done, what things cost to actually buy in terms of like materials and what the market is doing. Yeah. We're not tapped into that market. We don't have a pulse on it. Yeah. Like we have a pulse on design. That's our lane and we stick to it. So anytime someone's like, oh, what's this going to cost? We can give you an idea, sure. But it's like we always advise, talk to your contractor, have a contractor look at it because they're the ones that have the pulse on that particular aspect of it.
We do get a lot of requests for pricing, like what's this going to cost to build? And
You're like, I have no idea.
Well,
Don't ask
we
me.
have an idea, but we say you need to go and talk to a contractor who has their,
we
their
just
hand
do
in the pie.
Price per square foot on average based on what we've done recently. But
it's vague. It's vague.
Yeah.
We always have to you always have to validate what you're looking at, and you have to go to the expert in that case.
And technically, my lending doesn't require that. So. Are you putting that pulse on there? Do you have the right team? Because like even my contractor that I use on our rentals, I mean, they just ended up doing over 500 flips this year. They clearly have a pulse on the market. I mean, once you do enough quotes with them, you can kind of take their last quote and mimic it to another one very easily.
Yeah.
But like, do I think there's many of these contractors in any metro area? No, that's an exception to the rule because I think 500 flips a year, that like makes my head spin. I can't even imagine.
On 50 a month.
Isn't that crazy?
Yeah.
Can you imagine?
A little bit less, but yeah. It's a lot.
Yeah.
It's a lot.
Well, and to play into that, so in a hard money loan, once we close, 100% of the rehab is held in escrow, and it's done on a draw process, meaning that work has to be done for you to get your money.
Yeah. You had a story about something, right? Some guy in Chicago, was it, or somewhere?
Oh.
What,
I have all the stories, but
well,
what did I say out loud?
I think you were talking about like how he was driving appliances from like house to house or something like that and taking the photos and then, oh yeah, we're done. Send the money. Oh yeah, we're done here. Send the money. And he was just driving around to the however many properties he had and just like taking the same things and putting them there temporarily.
Oh,
was that something like that?
No, I remember you
I was
telling
going
me.
to say that sounds terrifying in
Yeah.
my world. That was not me.
Or maybe it was not you. Maybe it was someone else you knew. Or maybe it just came up in conversation.
I do believe that fraud can happen in this space very casually.
Yeah.
That's why you have to have a pulse on your team and on the project.
Oh, I had a scenario recently where an out-of-state investor rehabbed a property. He's keeping it as a rental now, and the gutter was damaged when we got the appraisal back. Damaged enough where the lender was like, "Hey, we're not going to close until this is fixed." He texted me. He's like, "It's done. Have them come back. Have them verify." And I was like, "Great." I get a call from the lender, and they're like, "Hey,
it's not done.
It's not done."
Yeah.
And I call the client, and he's out of state, which we work with out of state investors all the time. Very, very normal in our space. But with that, they have no one to cross their T's and dot their I's and make sure they're actually doing the work. The work was not done. He raised holy hell. I think it's getting done this week. But I mean, it's just little things like that that you really just need to make sure you're working with somebody reputable that you can trust to take on projects like this.
Yeah, and that goes back to like what Nick said earlier. You know, if you have someone that's licensed, there's a little bit of a guarantee there that you can trust a little more. Or again, like if you don't have the relationship, go to like if I were to get into something, I would number one person, I'd go to Nick and say, "Hey Nick, who do you know for this? Who do you know for this? Who do you know for this?" Because he's actually done it a couple of times to where he has a list of people.
Oh yeah.
I would be scared personally to go out on my own and be like, "Okay, Mr. Contractor, you're going to get everything done the way it needs to be, so I can get so everything works out."
I don't know if you know this about me, either one of you actually, but when I first moved to Columbus about 8 years ago, I started by not being a contractor, even though I was licensed in New York, or a realtor, which I was also licensed, but I started as being just the point of contact. And I didn't even call myself a project manager. I literally was just checking, the checkpoints after certain work inspections, making sure they
boots
get
on the ground.
Yeah, I was their boots on the ground. Thank you for that.
Yeah, I got you.
For all out-of-state investors. And that kind of gave me the bug even more. And that really what led to me having a portfolio and doing coin and going down this path that I'm on.
Well, it's back to the reps. You got to see the things that they were running into without having to spend the money yourself.
And I'm so glad I did, because people would do things wrong.
Yeah.
And
regularly.
Yeah. And
we should never expect, like, perfect example, like my contractor is incredible, but everyone makes mistakes.
Sure.
And if you're not keeping an eye on your project well enough, again, that budget is strict. Like if we have $100,000 budget, that doesn't mean it becomes 105 because you went over budget. No. That means if it goes to 105, it's coming out of your pocket.
Yeah.
So you need to just manage. I had someone recently tell me, well, there's a actually, yes. Hold on. It all came in. I was like, oh. So there was a contractor that has project managers. So yeah, there's someone overarchingly managing this project. And she was like, well, then I shouldn't have to manage this myself. And I was like, technically those are facts. And yes, you're probably paying a tad bit of a premium to have that layer. But no, you definitely need to still be involved. And to play this back to the design aspect, if you just let a contractor, and no offense to contractors, but they don't want to have a design eye in most cases.
No,
they're just there to do
slows
the
them
work.
down and costs them time.
Exactly. They want
money.
to just do the job. And if you want it done a certain way, they just need to know that.
Yeah.
If you leave it all up to a contractor, the design, those little quirks, those little things that are going to stop someone. Brooke uses the phrase, stop the scroll. If you're looking on Zillow.
That's good. I like that. I'm going to start using that.
Yeah. So if you're looking on Zillow and you're like, oh, I really like that house because it has, that's what you need. You have to have something to stop them from looking at all these cookie cutter flips that are happening in the area.
I will, even if you have documents, if you have a contractor that's just not good. And again, like a mistake is a mistake. Okay. It happens. We're all human.
Yep.
Whatever. Anyway. So, but if you have a contractor who just has drawings and just ignores them and does whatever, right? And then all of a sudden you're like, well, you didn't build the stair the way the stair was drawn, and so now
Let's
there's a
not talk about
clearance.
that project.
PTSD.
You don't even know what. Yeah, maybe there's a couple of. But anyway, it's like that leads to an issue with the door, which leads to an issue with the room, which leads to an issue with, and it's like all because you decided that for whatever reason you were going to shift something or build it slightly different than what is right in front of you. That's been thought and designed and drawn, and now all of a sudden you're causing 4 or 5 other issues. And like you said, all of those things are going to impact the cost to remedy and fix and make it the way it should be.
And the holding costs. So again, holding costs is the interest-only payments that you pay every month to the hard money lender as you're doing the project. Yeah. I would say we never really want our clients being in a hard money loan longer than ideally 6 months, unless this is like a massive rehab. 6 months is too long almost for anybody.
I'm usually longer than that. I'm usually like 9 to 12.
I was like waiting for you to be like, well,
12
11.
to 18.
11 and 3/4.
So
24.
So trust but verify.
Just so we're all aware, these are 12-month loans.
I want to go back to and talk a little bit more about the process from getting that draw, what that looks like, what that even means. I mean, I know you have a third party typically comes out, checks and verifies the work, boots on ground.
And those people are sometimes just people.
Yeah.
They're not licensed inspectors. They're not licensed contractors. So they're there to verify, okay, the bathroom was installed. There's a vanity. There's flooring on the ground. There's paint on the walls. There's the light fixture. And yes, the water works.
Yeah.
But they can't necessarily confirm the quality of it.
Correct. And they're not there to confirm the quality of it.
Yeah. Which is why pictures come into play also. Everyone should be looking at those.
Yep. Yeah. And then from there, so I always say, anytime an investor contacts me and it's like, my draws are taking too long. I'm like, okay, tell me about your last draw. When was the work done? Work was done on Friday. Cool. When'd you order the draw? Saturday. Cool.
Okay. Yeah.
Cool.
Yeah.
So no, I mean, you have to kind of think a couple steps ahead because you know that, hey, an inspector is going to come out here. Well, this inspector has to be notified. Like if it's done on Friday and you tell them on Saturday, they're not coming on Sunday. Like that's not how this works.
It's going to take a couple days for them to get out, and then it's going to take a couple days for the money
to transfer. So I would say, hey, work's done on Friday. You probably want to order like Tuesday, Wednesday. That makes sure that by Friday they can attend that. Now let's say the work's not done. Reschedule because you pay for every draw, roughly $200.
Yeah.
And so if you have them come out and it's not completely done, I use the phrase think like the bank all the time. If this was your money and it was 3/4 of the way done, would you give 3/4 of the money back? No, you're probably going to give like half the money because you want to make sure
you want to
the
stay
other
ahead.
quarter gets completed.
Yeah,
you want to incentivize the person to get it done. And so you'll get those investors that are like, well, they only give me half. And I'm like, well, it wasn't done. Like you don't. To a certain extent, the draw process can protect a new investor so much.
Absolutely.
So much. And I think sometimes when you get all sideways, I'm like, rein it in. This is protecting you to make sure that a contractor doesn't not finish the work in its entirety.
And take the money and run away with it. Yeah.
A strong market like Columbus can also protect a new investor. Yeah. So because property values are going up.
Exactly.
But yeah, I
oh God, I don't even know.
You got a story?
No. Let's stay on the process of this all. So it takes a couple days to get our money.
So a couple days.
Yeah.
And then let's kind of talk about, okay, the bathroom was you allocated for a half bath, I don't know, $5,000 to complete a half bath. I'm not saying like building one out. I'm just saying like, hey, it's there, it needs remodeled.
Yeah.
If it costs $4,000, I'm going to give you $5,000. So that extra $1,000, I don't care what you do with it. You should probably put it towards the project. But technically it could go in your pocket, no big deal. If it costs $6,000, you're coming up with the difference.
Yeah.
And I would say a lot of our investors will tend to pay their contractor and then reimburse themselves just to kind of keep their contractor happy. Talking about your team, like you need to have a conversation with your contractor if you're using hard money. Some contractors are big enough to have lines of credit and use the line of credit to keep your project moving and grooving without having to have those draws. But if they don't know that, they're going to be like, oh, this invoice is due on Friday. I want paid on Friday. Well, what I just told you is, you requested your draw on Wednesday. They're going to come out on Friday. They're going to say yes. It's probably going to be Monday, maybe Tuesday before you get that wire.
Maybe Wednesday.
And then you have to then wire it out.
Yeah,
so
which then will take another couple of days.
Exactly.
Yeah.
So it's just being mindful of how the process works and functions so that you can let your team know how it's going to work and function. You can have assets in place.
There it is. You have that conversation with your contractor, your subcontractors, and let them know the expectation in advance.
Before you're in contract.
Yeah.
Before we even get down this rabbit hole.
Or just have that line of credit, 10, 20% of your budget.
Yep.
Hopefully you don't have to touch it, but you have it just in case we're waiting on a draw, we're waiting on this. Because here's the thing. If you don't have that relationship and you don't have that clarity between, that understanding, your contract might stop work, or he might delay his subs. He's like, I'm going to send my plumber to another project where I'm getting paid, and this is going to be on hold. Well, guess who's paying for that holding cost?
You are.
Yeah. And it adds up, especially if we're at 9, 10%, 12%.
I was going to say, so math is always easier at 12. And if you're a new investor, you're getting 12%.
Sure.
So back to, let's just say $100,000 loan amount. So not the same scenario with the ARV. 12%, it's $1,000 a month in interest. That adds up pretty quickly. Now we do have like drawn interest lenders that do things a little bit different that can save you money on a monthly basis. But sometimes when you're like analyzing a deal, it's easier just to do full note interest and go off of that $1,000 number, which I would say that's a big thing of looking at a transaction and being able to do like back of the napkin math is key. But yeah, I mean, if that project goes a month longer, you're $1,000. If it goes 3 months, now we're $3,000. And again, I'm talking about a fairly small deal.
It's usually, I would say close as 3 or 4 times that.
3 or 4 times that. Yeah.
Exactly. And especially if you're trying to, get into higher A-class neighborhoods and stuff like that, like those costs are detrimental. I mean, we just did a deal in North Carolina that was like almost a $3 million hard money loan. And I slightly got sick just thinking about what their holding costs.
Yeah. Well, listen, if it's a flip, I'm losing sleep at night. Because now my bottom line, I'm putting all this work in, I'm paying taxes, the highest amount of taxes, and I'm selling it, and that's it.
Yeah.
We all like a big lump sum of money, but it's gone forever. If it's a rental, we might get punched in the gut, but on a long enough timeline, we get that money back through cash flow and equity. Yeah. So, I mean, it really, you kind of get used to being comfortable with these types of situations, and you find your groove, and it's a little bit different for everyone, I think.
Well, oh my gosh. I mean, even my higher end investors still run into problems. And so like this the understanding that the higher end investors, they don't run into anything. Everything just works like a well-oiled machine is not the case. Like that's not a thing.
There's no problem.
I don't care how many deals you've done, like stuff like
there's
this
always
will come up.
always something.
Exactly.
Always something.
You don't know what's behind those walls. You don't know, like there's always going to be something that comes up. But I think for the newbies, it's just like slow down. Like, I know you're excited. I know you want to jump into a deal. I know you want to do this. I know you want to do the highest of end of finishes.
Start
but like,
small.
Just do something manageable. Like do simple rehab, 30, 40 grand in rehab, and like
update the bathrooms, update the kitchens, put in, rip out the carpet, put in some luxury vinyl, paint. But maybe we're not gutting the house. Maybe we're not, let's keep it easy. And
if we do 6-figure flips on a first-time investor, I just sit there and I'm like, oh, this is gonna be fun. I'm gonna get a bunch of phone calls. Like I know I'm gonna get a bunch of phone calls, and it's just anxiety. I'm like, guys, do we have to go this big so quickly? Like learn a couple, get some, and get your capital going as well.
Dip your toe in and don't just like dive in head first into the deep end. That sort of mentality, right? Like get a feel for it. Get an understanding, maybe start to build out some of that team that you're relying upon. So
and
that
your systems. You have so many systems to put in place. And if you don't have those in place, you're going to learn this on that large of a transaction. Whew.
Yeah.
I mean, you may not make a lot of money on that first one, but I can tell you what, you'll probably learn a lot.
Yeah.
And there's value there. There's value there.
Yeah, I was going to say, I think that's solid advice.
There's been a few flips where I haven't made a whole lot of money, to be fair.
Yeah. Well, that's that 12 to 18, 24 month timeline.
There you go.
Who's the problem?
We've sold.
But I want that hidden secret cave entrance.
We sold houses for $700,000-$800,000, and I've made, I'm embarrassed to say, I've made, $40,000 just because that's it. That's all we made. Where we could have made the same amount of money on 3 houses. For that price point, you know what I mean?
We talk to investors a lot of like, what's your time worth?
Yeah.
Think on that one. So, hey, that project took 12 months, 40 grand. Was your time worth? I'm gonna make math a little simpler. $3,000-$4,000 a month.
I thought a lot harder about my time after that, and it really depends. Although I'm typically juggling a lot of different things.
Yeah. I know from our side, it's always like, we need it now, we need it tomorrow, right? Especially when you have an investor, it's like, oh, what? I just sent you a whole ton of stuff. You're not done with it yet? Like, I need to get it, to my contractor so he can get the work done, so I can get the draw. So, so I mean, like, especially someone that is newer to it, they're definitely always putting pressure on us too, to like get things produced and out the door as quickly as possible.
I'm so sorry.
It's the nature of it. Like you said, time is it's the nature of it. It's just how it is.
Every day of a transaction in the fix and flip space costs money, and so
well, especially if it's a larger transaction, like you said, and it could be a $4,000 price tag for that month. Yeah, a month can go by pretty quick.
Oh.
Yeah.
So for your properties, Liz, how do you approach the design aspect of things, and what do you put a lot of value on in terms of getting that ARV to refi?
I would say, so again, you have to remember mine are rentals. So I'm very much being mindful of what's in the neighborhood. What am I correlating to? And I think too often people are trying to design above or below where their market is. So just being super mindful of your market. Also, like, have some integrity and some like pride in your project. I feel like some investors start to lose that when stress and anxiety kind of becomes part of the process. And so this is your project. Your name's on it. Your name's on the title.
Yeah.
You're going to be the one selling it. And I think just being mindful of like what product you're putting out. Again, that doesn't mean you have to go above and beyond and put secret things. But I think there is a level of just like, this is the product you're putting out. Are you happy with it? Or in the future, what would you want to do differently? And what do you think would sell this better? I think ARVs, like, you have to just focus on where's your ARV at and what are the rest of those ARVs have in them? Do they have finished basements? And are you not finishing in this basement? Do they just have those added benefits and that level of quality, but you're not? Because I would say, again, our hard money lenders are going to do their due diligence. Otherwise, they wouldn't be cutting checks like they are. But at the same time, there's a level of responsibility that our clients have to ensure that the quality that they're putting out is appropriate as well. Because, let's just say we're putting $20,000 for a kitchen. Well, depending on if a contractor, someone that's maybe not paying labor, what they can put out for 20 grand and what I, as someone who would be subbing this out to someone, what I would get for 20 grand is completely different. And so it's just making sure that those allocated costs are, appropriate. So I just think slow down. I sometimes rein investors in all the time. I think I've said 2 or 3 times this week, like, I talk people out of deals more than I talk people into deals. That's just like my mama duck mentality of like just trying to protect them from getting into upside down deals. And I think from the design aspect, you guys try to as well, of just like being like realistic about what we're trying to accomplish and what the building will allow.
Sure. My conversation with homeowners is a lot different with investors.
Yeah.
So yeah.
But I mean, like, in general, like you said, we're trying to guide them the right direction, no matter what, right? It's like you have a certain desire, but then if you have a budget and finance concerns, okay, we're going to steer the conversation this way. Yeah. But yeah, you have to rely on those team members. Yeah. If you do get into something that's upside down, like, basically they're on the hook for it, right?
100%. Yeah. So
that's why you're like the, protector. Hey, I don't want you to get, into too much. This is what you're looking at.
I said this to one of our salespeople. I was like looking at a deal, and again, I'm the numbers girl. I look at it and I said, these numbers don't work. Sell it on me. Sell it to me at this point, because I'm not seeing it. And he's like, well, the appraisal came in short for the ARV, but he's confident he can get $700,000. And I was like, oh, okay. So I like jump into Zillow and I do just a simple like, what is sold recently, and I was like
550.
So it was in upper, and he was like, I'm gonna get 7 for it, and I'm like looking at comps, and I'm like, I don't see anything with a 7, in this like pocket of upper that they were considering, and I'm like, what gives you the impression that your house is so special? Like, and I told him, I said, you need to have a conversation with the client. Like, we're gonna lose this deal maybe, and that's okay, because if this client loses 100 grand on this transaction or 50 grand. He may never invest again. We may never have a client again. So don't get short-sighted by a $2,000 to $3,000 commission check compared to the longevity of what this client could be.
No, if there's a project that stops somebody from being an investor, you're losing that business forever.
And relationships spread. Yeah. So you lose though LFG was not the reason why that guy lost $50,000 to $100,000. He made a bad financial decision. People are still going to remember LFG was a part of it.
Yeah.
And could LFG have done something different to protect him? Is that our responsibility? No, but there's a level of it.
Sure.
Yeah. Well, it's the same thing if someone walks into, our door and says, hey, I want to do this, this, and this. Okay, but have you thought about, the flip side of that? Like, it's going to cost you and you may not get your money back out of it, and et cetera, et cetera, et cetera. Like, we can certainly do it if you want to, but we don't think it's the right choice. Yeah. We think it's better to maybe use a different finish here or configure the space a little bit differently so that it's, whatever. And then it's like, again, if he comes in and he puts his foot down, no, this is what I want to do. That's it. That's how it is. Okay, then it's like, again, it's like we're still a part of that transaction. He's going to leave a sour taste in his mouth, and he's probably never going to come back to us because, this architect designed this, and it's terrible. It's like, if you don't listen to our advice, what can we do?
Yeah.
Yeah, I think it's a delicate balance between listening to what the client wants, making potential suggestions that's going to improve the situation, whether it reduce costs or bring more value, and then having that conversation with the client and making sure that
they're aware.
Yeah.
Self-aware.
And obviously some of this stuff is a little bit subjective, but I mean, at the end of the day, again, if you're looking at comparable properties or things that are going on in the neighborhood and you're doing something completely different that just doesn't make sense, it's like, what can you do?
It could work.
It could work,
not work.
but it could also, I think more times than not, it's probably going to work against you. If you're going off, if you're Maverick and you're doing whatever.
I don't know. I bet it's
put in the reps.
What, you think it's 50-50?
I bet it's 50-50. I guess it depends, like, does it make sense? Or are you totally mavericking? Like, are you totally going
No, I'm talking like off the rails.
Yeah, okay. Then it probably doesn't work. Like,
I'm talking about the cave cellar that Nick wants.
Yeah.
There's nothing wrong with that.
Hey, listen, I sold a house
in Hilltop.
Okay, now you're in it.
I don't invest in Hilltop, but I've sold houses for $700 that were the highest we saw in the neighborhood were in the mid fives. So I mean, I'll stretch sometimes.
Well, and I think and what I told our sales member was more so make sure he's aware, because he was a newer investor and he has the money. So like technically and so the number I did was, okay, what if you have to keep it as a rental? And that is your worst case scenario. Well, that should be your worst case scenario no matter what. So we tend to advise clients of, it's so funny. I had an investor recently. He called me and he's like, hey, you told me if I hit 265, I'm supposed to call you. I'm not actually sure what I was supposed to call you about or what we were doing, but 265 was the number. We're at 265. What do we do now? And I was like, you're adorable. I want as many of you as humanly possible. Yeah. And I was like, hey, 265 is the moment that if you drop your list price any further, in theory, if you couldn't sell it for 265, is it worth 265? For an appraiser, probably not. If you go under 265, then you're going to have to bring money to closing to refinance out of this. I would say anyone's worst case scenario is refining. So in this scenario of this, potentially ambitious ARV that he was striving for, I was like, okay, well, let's just say magically, we're right and 700 isn't doable. Could he keep it as a rental? And I couldn't really see the cash flow either. And so it was like, well, you don't have another exit strategy. You want as many exit strategies as humanly possible. Yeah,
but if you're going to lose $50,000 on the flip, I'd rather suck it up and lose $10,000 a year on a lower rent, right? And put in $1,000 or plus a month and pray the market change. Maybe there's some hope to it.
There wasn't confidence in like the simplest sense of like, yes, you could refinance out of this loan and like at least break even. And it was like, no, there's going to still be some layers on it. So as of this morning, actually on this deal, the ARV was increased by like $15,000, but it's like $700,000 deal. So $15,000 isn't a lot. I think they're still proceeding. Okay. So you'll have to nudge me and get a check-in on how this thing sells.
But those are the deals you really learn. Like you sharpen your teeth on that. And it now things that are a little bit bigger, like where we had to knock down a house and rebuild it completely, that doesn't scare me as much as it used to, which would typically terrify me, right? Because I don't want to do an addition or add this on unless it's bringing lots of value.
How much time do we have?
We can go a little longer. We're close to an hour.
We do new construction. I guess like just because you said building. I would say
we can always have you back too. Don't forget.
Well, then, We do new construction. I think in the next like 5 years, that's going to be definitely a thing. There's just not enough housing in the United States as a whole.
Well, that was the whole reason why Columbus got into the zoning change that they did recently.
Yes.
It was because of literally housing was the number one issue.
Yeah, housing and density.
Yep.
And so with that, the tough thing about new construction is it's like credit. We don't start out with 800 credit and then you ruin it.
Right.
You start out with no credit and then you're supposed to establish it magically. So new construction financing is kind of like that. So I don't love it in the sense of like you can't get new construction financing without having new construction experience. So you may have to lean on a partner that's done this before and maybe bring them in on that first deal just to get that one under your belt.
Yeah.
We saw a lender maybe this past week that teased me with the possibility of no experience as long as you have a GC or a builder, which I would say a newer investor probably would naturally. And when I say experience, I mean like direct new build experience, not a flip, not a heavy flip either. Like, yes, I would agree that
show me your portfolio.
Yeah.
Potentially $100,000 to $150,000 in rehab is probably more intensive than an actual new build, but the lenders are kind of cut and dry, new build experience.
Yeah.
But supposedly we're getting some teasers that some lenders are starting to open up those parameters, which I think is going to be huge.
And I will definitely agree with you. A new build mentality versus like a renovation is completely different. A lot of times, like our clients will be like, why does this cost two times more to draw something up? You know, last time it was a renovation. Yep. This time is a new build. There's a whole lot more, even on the design side of it, that goes into, you know, a new build drawing, you know, so just that alone, like, yeah, of course the cost is like 2 times more.
Yeah.
Maybe not to build it, but I mean, like to draw it and design it. Yeah. There's significantly more time.
Yeah. So some of those costs that people aren't used to will need to be re-engaged just to make sure they're allocating accordingly. But I would say that's going to be the new thing probably in the next 5 years is a ton more in that space.
And even we're doing a lot of new build. I mean, we've done what, 30, 40?
Something like that. Yeah.
So it's really picking up.
Awesome.
Liz, I know you guys have a really cool YouTube channel and you kind of address a lot of these challenges and acronyms and definitions and all these different things. Tell us a little about that before we sign off here.
Yeah. So me and one of our sales members, Adam Messmer, have a podcast called The Loan Lounge. Definitely check it out. I would say in this investor space, no matter if you're brand new or your experience, education is going to be key. And we go into the nitty gritty of just like, what's a good transaction, all these acronyms, ways to protect yourself, just getting into trying to give you all those little tidbits that you need to know that honestly, unless you do a transaction, you may not run into. So learn from us and our investors that are doing transactions every day rather than running into them
It's less
yourself.
Expensive.
Way less expensive. A couple clicks, subscribe, listen to me a couple times a month, and you'll be solid over 2025. So
I love it.
Thanks for having me.
I had a lot of fun. This is what I get into.
Oh,
so,
yeah.
Yeah. Well, great. Liz, we're gonna have to have you back.
I hope so.
Or maybe we can.
Did I make the cut?
Yeah, of course.
Or maybe you can have us on your podcast.
Yeah.
We'd love that.
Great.
We'd love that. Thanks, guys.
This has been the ArcFluence Podcast. As always, you can get more information and additional content on arcfluence.com. Please subscribe on the platform of your choice and leave us a review. We'd love to hear from you.